Hi and welcome to Swissquote's Daily Market Talk. It's Monday, May 5th. The week begins with a sharp fall in oil prices. The US dollar remains under pressure, especially against Asian currencies, while the US futures are in the negative following a strong 9-day rally on softer trade tensions and despite some gloomy earnings forecasts as well. So we will talk about all that, but before we do, please be reminded that opinions that I will be sharing here in this video are my own, and this is not financial advice. So the new week begins with a sharp decline in oil prices, more than 4% to be precise at the time of talking here, some 2 hours before the European Open, as OPEC plus countries announced that they will accelerate their oil restoration plans by 411,000 barrels per day starting from June, taking the total hike for April, May and June to nearly 1 million barrels per day, almost a half of 2.2 million barrels per day restrictions put in place from October 2022. Since then, the OPEC countries have quotas that they should respect to keep oil production of OPEC limited in order to support oil prices. The idea here was to stabilize oil prices near and ideally above the $80 per barrel level. Now remember that Saudi Arabia was doing the heavy lifting. At some point, they even decided to cut 1 million barrels per day unilaterally and additionally to help the group achieve these goals, while countries like Kazakhstan and Iraq were often accused not to comply to the extent of their promise. And last week, while Saudi Arabia was already giving some hints that something big was about to happen in the oil production plans when it announced that they are ready to go with lower oil prices for a prolonged period of time. So the weekend news from OPEC weren't a shocker, mind you, but the reasons behind the move remain quite uncertain. Because official communication says that the group is bringing barrels back to the market as the fundamentals of the market are healthy and inventories remain low. But that's obviously BS in my opinion. The global growth expectations have been tumbling, they have been crumbling due to a heated trade war between the United States and the rest of the world, and rising oil output only increases the exceeding supply worries in this market. So the reason behind the latest decision must be something else. Now, some argue that Saudi Arabia is willing to punish some OPEC members who showed poor cooperation over the past few years in terms of quotas like Kazakhstan and Iraq. Others point that Trump wants oil prices to be lower to support his Made in US plans and hit Russian finances to bring the end of the Ukrainian war faster than otherwise, and Saudi Arabia may be teaming up. Some others warn that lower oil prices will do nothing but to destroy the US shale industry that actually becomes profitable above or around the $40 to $50 per barrel level, and including capex, land, debt, and etc., the break-even rises to $55 to $65 per barrel level, and for some small companies, fracking costs could reach up to $70 per barrel level versus $3 to $5 per barrel level for Saudi Arabian oil. And note that around 90% of crude production growth in the last 2 decades are said to come from the US shale oil. So that doesn't necessarily match Donald Trump's frack energy policy. And as such, some question whether Saudi Arabia is also willing to punish and push the US shale players out of the business and increase its market share. Now, we don't know for sure what are the motivations. The exact reason remains quite obscure, but the direction of oil prices are way clearer than the reasons behind the OPEC's latest moves. If Saudi Arabia is actually ready to dive, oil prices have room to further dive along. So the barrel of US crude tanked to $55.50 per barrel level at the open this week. Brent is down by 3.80% at the time I'm talking here this morning. The bear's $50 per barrel price target seems easier to achieve now than 3 days ago, and price rallies that we might see in oil markets will likely be interesting opportunities for the bears to strengthen their bearish positions. Voila, that's pretty much it for oil. We will be watching the prices closely. Now, obviously, lower oil prices are a straight positive for bringing inflation lower, and last week's data from the Eurozone countries show that any factor that could help taming the inflationary pressures in the Eurozone would be more than welcome. As the early inflation reports for April actually warned that the Eurozone economy is facing an inflation that remains quite unexpectedly steady in April, and worse, underlying measures like core and services inflation that are closely watched by the European Central Bank to form policy, they are rising. The latter actually softened the dovish ECB expectations last Friday, but still the combination of falling energy prices, a stronger euro, the European Central Bank's support, and higher government spending as well continue to support the thinking, the idea that the euro area growth will probably pick up some more momentum later this year. Across the channel, the Bank of England is preparing to announce a 25 basis point interest rate cut this week when it meets on Thursday due to the tariff uncertainties and the potential negative impacts on the UK economy. The British 2-year gilt yield fell more than 35 basis points since April 2nd when Donald Trump revealed his mind-blowing tariff rates. Now, note that the UK is hit by a 10% tariff only, but it's probably enough to weigh on the UK growth. But the strong sterling and the expectation that the US tariff war will be disinflationary for Europe and the United Kingdom, if nothing due to a Chinese dumping of its products into Europe and their stronger currencies, will give the BOE and the ECB room to cut interest rates more than they otherwise would this year. In the US, the Fed, those are much less optimistic, however, about the Fed's motivation or its capacity to cut the interest rates. First, Chair Jerome Powell clearly highlighted in the recent weeks that inflation's trajectory for the US remains highly uncertain due to the tariff policy, and that pushes the Fed to be cautious before cutting the interest rates, and that despite slowing growth in the US. Now, some Fed members look like they are turning somehow in favor of doing something about the rates to give support to the US economy, but any action should be based and backed by economic data. Speaking of which, Friday's jobs data from the US came in, well, mixed really. The headline NFP figure blew past expectations, and the wages growth also slowed more than expected by analysts. So these are good developments for the US economy and for the Fed. But the previous 2 months' reads were actually revised lower by a combined 58,000 jobs, and the unemployment rate in the US remains steady near the 4.2% level, while the participation rate rose, hinting that more Americans are looking for a job now. Though it's too early, obviously, to see or to imagine the impact of tariffs on the US jobs market, the impact will likely be negative. So that's in favor of a dovish Federal Reserve policy to the extent to which inflation allows them to act. The next CPI update from the US is scheduled for next week only. So until then, we will be busy talking about the Federal Reserve and its policy. That is actually expected to announce no change to its rate policy this week when it meets Tuesday and Wednesday. So in the FX markets, the US dollar kicks off the week on a bearish note. The Asian currencies are soaring against a wildly weaker US dollar. The Taiwanese dollar, for example, is up by 3.5% against the US dollar, maybe on trade news that will be announced later today. So that could also shape and shake the broader FX market. So we'll be watching that this afternoon. And the Hong Kong dollar is also seeing strong demand, forcing authorities in Hong Kong to buy dollars to protect the dollar, Hong Kong dollar's peg. Now remember, last week was marked by softish news on the trade front. Donald Trump actually slowed his attacks, and there are reports suggesting that China gets ready to talk about these tariffs. So the S&P 500 posted a 9-day winning streak last week, so its longest bull run since November 2004, as earnings from big technology companies also mostly defied the bearish expectations, though sentiment among the Magnificent Seven companies is now diverging due to the tariff impact on some companies more than the others, and futures point at some downside correction at the start of the week on side news that the US will impose 100% tariffs on foreign-made films to save eyesight dying Hollywood. This is what Donald Trump said. He thinks that Hollywood is dying and it needs help. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.